Hey guys, we're here with the Holy Macro Show. It is Friday, and there's so much going on in the markets right now. And I feel like I say that all the time, but it kind of seems like that. And the times I say that more often is the end of the year. Once we get to year end and we start to get these real big moves that happen in the market, one way or the other. Some days it's the years are bucking the seasonality and you're seeing a lot of tax loss selling and so on. Other years it's going with the seasonality and we kind of get a year end ripper. To me, what I think is interesting is like, are we moving up to the end of the year? Seems like it, but where are we moving up is the interesting part. And it seems like we're moving up in a lot of areas that a lot of people have overlooked. Energy is looking good. Gold miners are absolutely unstoppable. When you look at silver, that's been making a big move. Somebody told me to not talk about silver yesterday because it was down a little bit. I was like, "What? It's been that's been the most ridiculous trend in the market. Of course, it goes down once in a while, but man, it's going to go right back up, and it's been killing. I don't know. Nobody knows when a trend will end. That's the most significant thing to always think about as a trader. But if you're looking at the sectors, we're looking at, whether it's steel stocks, metals and mining, aluminum stocks, some coal stocks are even looking good. We're seeing a lot of them moving right now. So it's definitely interesting times in the market and kind of that big shift. And we'll also get into the dollar today and highlight some of these sectors we're seeing moving. And then we'll finish up with some energy talk. So, Kashap, how you doing today? Anything you
I'm doing
saw this week in the markets that you want to shout out? Does anything happen that was exciting, or did Donald Trump tweet something that made everybody lose their mind this week?
no, I think overall, compared to the last couple of weeks, this has been the most uneventful week. We just had straight 8 up days in a row on the Nasdaq. I don't think that's rare. I don't think that's common either. So we had the, I think we had a bit of complacency, like, hey, the Fed is going to cut and resume QE next week, so let's all party. Besides, it's called running for the roses, apparently, meaning you get a rally into year end because fund managers position for, lightly uh, improve their P&L, improve their profitability. So we have all those trends going on. So I think investors are complacent. They think everything is just going to continue as normal, and they may be right because mostly nothing big happens in December. They may be wrong because it's always the one thing that you don't expect that really surprises you. So I don't know which way we are going to go, but all indications point to stocks doing okay since the Fed QE is going to come next week. So we'll see. I don't really have an opinion on how this moves now.
Yeah. So one question we had, and we're gonna go through a couple shippers. By the way, my screen over here is like tweaking. If anybody is seeing, it doesn't seem like it's showing up on the live, but if somebody could also just answer in the chat, like you guys aren't seeing that, because I'm just seeing I guess my chart patterns are twerking today on my end. Doesn't look like it on the live, but let me know if you guys are seeing that on the live. But so Kashop, I got a couple questions about shippers. So if we're looking at shipping stocks, and we, basically the question was about clean shippers. I'm assuming they meant dry bulk shipping, as opposed to ships that are shipping oil and other products. So, what do you think about the difference here? Do you think we should be investing more in dry bulk shipping? Do you think we should be investing more into oil shippers? What do you think we're looking at out here? And then we also got a couple names to talk about.
So dry bulk was one of my bigger sector allocations at the beginning of the year because I thought it was completely undervalued and that's going to correct. And 2 3 months into the year, I realized, well, that's not happening. So I pivoted to the tanker stocks. So the tankers, the companies that transport both crude oil and the refined products. So I think by clean, they probably mean the clean tankers which transport the refined products. So I did that shift. That trade has worked pretty well. And dry bulk is okay, but dry bulk moves up and down. It's definitely tradable. But if you're looking at it from an investment point of view, I don't think there's good value there. Meaning the valuation, the things that you look for when you say, hey, this is a value stock, here's my Excel sheet, and this is the valuation model, this is the potential upside. All of those look great, but in the shipping space, those have always looked great. That's the kind of the point of a value stock or a value sector. The sector has always been value. So you have to ask yourself, if you are invested in this sector, are you going to make money right now? Well, I'm not so sure because I have tried catching the bottom. I have tried trading this for a very long time and it's not done well. Some stocks have done well, and those have done well because those companies have been acquired. So I had Eagle Bulk Shipping, which got acquired, Grindrod, which got acquired, and now Genco, there's kind of an acquisition offer going on. So in these situations, you tend to make money, but overall, you don't tend to make money. And that's pretty much what I've observed. So I would just stay away from dry bulk and focus on tankers. It's the easier trade. Now you can go more exotic and say, hey, there is value in the container shipping sector too, and you would be right. So Danavos Corp, Global Ship Lease, those are the companies which own these container ship vessels and they lease them out. There's tremendous value there. So if you're looking for value and you have a 10-year time horizon and you don't care about say 7%, 8% IRR, then absolutely go for it. If you're looking for something which is little more risky, then there's Zim Integrated Shipping. I believe there's going to be a takeover offer soon, or I don't know about soon, but it's in the works. So when that happens, you're going to see a nice pop. The stock has already seen a nice pop, so I don't know how much of this is priced in, but you could definitely look there. Dry bulk, other than Genco, I don't see much of the opportunities there. So it's not that there is no value in the sector. That's what I want to emphasize. There is tremendous value. But will you realize that value if you invest right now? That's a little uncertain. And that's the thing for me as a trader. So if I'm looking 1 year out and I cannot see a multi-bagger, or I cannot at least see a smooth return coming in from some fundamental catalyst, then I want to avoid it because I have very limited capital and I want to put my capital elsewhere. So that's the long answer as to why I would not invest in dry bulk today.
Yeah, I think also, as we look at that type of scenario, are we in a situation here where we're looking at some of these names? Should we be diversifying our bets here? Should we be kind of going some dry bulk shippers, some oil shippers, and so on? Or is it something where you think we should be more in one area or the other?
Okay, so if you're not invested in this area, then maybe definitely look at the names, all the names that I told you, and build a diversified basket. So my situation is I'm already in some of these names and I'm a 40-50%. So I have enough capital allocated to shipping. I just want to write this. And uh, it's not that I picked the best stocks and I'm going to write them and the other stocks are bad. It's just that the time in which I got in, these stocks have done very well for me. Some of them, like the names I mentioned, didn't do as well for me. So I sold them and I put the proceeds in these stocks, and that trade has continued to run. So when a trade is winning, when a trade is doing exactly what you wanted to do, why stop the compounding and diversify? So I wouldn't do that. But if I had fresh capital and zero shipping exposure, then sure, then I would take a different approach.
Nice. So I guess the other question on this was about investment in this area, and so he mentioned that, like, this isn't a trade for him, this is investment. So couple things I want to say about that, and I don't know the exact context of it, but just to give context for everybody here, um, I want to also say, when you think of a trade and you're like, okay, I'm trading this, like, you're trading it. Don't take a trade and turn it into an investment. That's something that every good trader will tell you. Like, sometimes, like, it's like when you own Bitcoin and it goes down, you're trading it and you're going to sell this thing, and you were going to sell it at, let's say, 17,000 back in 2017, or you were going to sell it recently at like around 100. And then you're just going to, like, when do you sell it? Like, well, you already said around 100, you sell it around 100. If you have a signal that breaks trend, you sell it when it breaks trend. Whatever it is, you know when you're going to sell it. Don't just go, okay, this thing's moving down. Now I'm an investor. I'm going to hang on to it for the long run. And also, in this type of a sector, we're talking about the most volatile sector probably in existence. I don't know a more volatile sector out there really than shipping stocks. However, like, they make a lot of money at certain times. Kashop's been really on point over the years of talking about when these things are going to make a lot of money, when people can be investing in them, picking great names way before anybody even had like words to say about these stocks. I didn't hear anybody talk about these stocks for probably 10 years. And then Kashop mentioned it. I think that was the end of 2019. into 2020, and then 2020 happens, and they ripped the face off the market that year, which was a pretty amazing trade. But once again, it's a trading vehicle, in my opinion. Because Shop, if you have a different opinion on that, I don't think you do. But what do you think about like holding something like this long term over the next 10 years?
You should never hold cyclical stocks for the long term. It's a short answer. Whether it's industrials, whether it's shipping, whatever you are in, if it's cyclical, then you have to just ride the cycle. If it's secular, meaning you're just holding a growth stock where revenues are growing, profitability is going. Let's say, take the example of Walmart in the 80s. Now, that's not a cyclical stock. Sure, it kind of moves a little bit to the economy, but the story there was the expansion, the revenue growth, the improved operations, and things like that. So those trends, they can last a long time. If you're looking at a commodity cycle, let's say you own the world's best copper producer, well, it's kind of going to follow the fortunes of copper, whether they do extremely well in their operations or extremely crappily in their operations. Because if you're crappy, then your valuation is quite depressed. And when you start making money, your free cash flow goes through the roof. If you're well managed, then you have less drawdowns during the bad times, but you still follow the cycle. So it's not that the best managed company is going to uh, not lose money when the market is bad. When the price of copper goes below their cost of production, of course they're going to lose money and investors are going to notice. So that will depress the stock price. So if you are looking at cyclicals, then you have to ride the cycles. If you're looking at a secular trend, then you can just ride the trend and be a long-term investor. So the shipping stocks, the way to do a long-term investment is to buy the preferred shares. So a lot of these companies, they have debt outstanding. Instead of direct debt, they have preferred shares. Those dividends are secure, so you can invest in those for the long term. But that's the fixed income part of your portfolio. That's not the equity part of your portfolio. So the approach will have to be different there.
Yeah, so that's a couple things I just wanted to go over in this sector real fast. So getting through to this name, so Starbulk. So looking at this one, I know it's been around a long time. I'm sure you know a ton about it. It is hitting new 52-week highs. Looks like a great new buy signal here. What do you think about this shipper? Do you think it's fundamentally? Do you think it's worth buying here? Do you think it's something that's overvalued, undervalued? And do you think it has room to run?
So it's definitely undervalued. There's no question on that. Can probably be at $40 and it would still be undervalued. But here's the thing, every single shipping stock or nearly every single shipping stock is undervalued. And there's a reason for that. And that reason is corporate governance. And the other reason is they tend to do these acquisitions which blow out the share count and disappoint shareholders. So, two reasons. Now, looking at governance, no, I'm not talking about Starbulk here. So, but there's another company in the shipping space which just made waves. It's called Top Ships. And they announced that they are going to diversify away from shipping into Dubai residential real estate. I kid you not. And why are they doing that? Well, their CEO owns a bunch of properties in Dubai and he just wants to put it into the company. You know, it's like how WeWork sold the V brand to Adam Newman sold the V brand to WeWork and a lot of his properties to WeWork. So you see a lot of these corporate governance abuses in the shipping space, which is why the entire sector valuations are depressed. Now, in Starbulk's case, they did a big acquisition and investors did not like that. And one of their big shareholders has been holding the bag since 2014 and looking for an exit. And that exit came at the expense of other Starbulk shareholders. So, a lot of confusing signals come from the CFO suite in this company. So, it is undervalued for a reason, but then if those reasons disappear, then you can see it go up very quickly in short order. So you can size it accordingly, but I would just avoid it because I have tried catching this falling knife over the years and never really had much success with it. So for me, it's just a company to avoid because there are companies which have much better corporate governance in the shipping space, and you can buy them and you can rest easy knowing that your capital is not as at risk.
Nice. All right, that was our shipping how-to at the beginning of the show. If you guys are ready now to go through a bunch of charts, like I wanted to talk about that stuff. I got a great question on the Substack. So if you guys do have questions for us on Substack, feel free to hit them through. I'll try to bring them up when I can. And then also in the chat, feel free to ask questions if you want to. But here we go with the dollar index. So every week we talk about the dollar. And I got a message the other week, which was, why do you talk about the dollar so much? And the answer is it's the world's reserve currency. It's everything. Everything is tied to the dollar. I can tell if we're in a risk-on environment. I can tell if the market's in a place where it should possibly be under some pressure. I can tell if I want to be in stocks or if I want to be in commodities. Range bound will tell me something. Trending down will tell me something else. So recently, getting here to 2025, we had this peak. Basically, I want to say that was all. It was a huge rally in the dollar that was all the way from, I want to say that started in October all the way to January of 2025. Then positioning got crazy offsides, meaning the smart money was crazy short, the dumb money was crazy long, and then next thing you know, we get this drawdown here. And so now we're in this zone, and what happens? So this is where it ties into the intermarket analysis for all of you guys who are learning how to use intermarket analysis as traders. Tied into, okay, well, if the dollar is trending down, what's happening? Well, I would expect international stocks to start moving. That happened. We've been positioned in that all year. I would expect the gold miners to start to move. We've been positioned in that all year. I would expect some of these commodities to start to move in the order that we've been talking about. We've seen that. The only one that hasn't really caught up yet is energy. Everything else is moving, though. If we're looking at gold, silver, palladium, platinum, miners across the sector, metals and mining sector, copper miners, lithium stocks, and so on. Even some coal stocks are moving nicely. So, the market is moving the way it should, considering the environment it is based on the dollar. And then everybody was like, oh, the dollar's rallying. I got a million messages about it. Now, once again, I trade on a very long-term time frame, especially if I'm looking at these major secular trends, like trying to trade something like international stocks or trying to trade something like gold miners and so on. Like I'm looking to trade the cycle for the most part. So like something that's a little move up here, that's not going to bother me. What I'm going to look for is how it acts around resistance. So we get in this resistance zone here. We come all the way back. We get near 101 once again. There's a VWAP right at that level as well, right here. And also the resistance zone is right here. When you look at resistance, you really want to kind of see where the most bars are hitting. It's not only just, hey, there's a line here. Like there's a phrase in technical analysis, which is you want to draw resistance with a marker, not a pen. And the reason why you want to do that, or a crayon, not a pen. The reason why you want to do that is you want to have a wide area, because you could put it right here and go, oh my God, it got above that. I better buy this thing. It's going to be great. Or you could draw it wide and then go, okay, when it gets above this entire level, then maybe I'll think about it. For me, I still wasn't really sold on it. Even getting up to this level, 102.5, like that's not a big enough retracement to say, hey, we're going to actually change trend here. I think the dollar will continue to make lower and lower highs. And I think we're headed down to 90. Like I'm pretty certain that there's nothing that can keep the dollar to hold itself up here in the environment we're in currently. So Kashop, to pass to you, what do you think about the dollar here? Do you think global monetary policy is getting to a point where the dollar could strengthen at some point soon? Or do you just think it's going to be people are going to get very excited and positioning is going to get offside once in a while, and then it could trend back lower?
So the dollar moves along with US equities. If equities strengthen from here and we get Nvidia to 10 trillion, Google to 12 trillion, whatever crazy valuations you can dream up. So if you get a melt up scenario like that, then yes, I think the dollar will do well. What are the odds of a scenario like that? I would say near zero, because the AI bubble is bursting. It is quite obvious to everyone. The K-shaped economy where everyone with assets makes money and everyone without assets is kind of doing terribly, that is making waves. So the bubble, the bloom is off the rose, to put it that way. So I don't think we are going to have much bigger moves in the S&P or the Nasdaq, mainly because of the concentration. And I think with that, the dollar will start to tank, because investors will realize the party is over, time to go into international equities, time to go into other areas. And especially looking at copper, the way copper is moving right now, it just signals that the rotation out of equities and into commodities is strong. And the way oil is fighting to hold $60 and the way natural gas is moving, it's now over $5 again. So all of these tell me that capital is already shifting out of equities and towards commodities. So it is just inevitable as that rotation continues, the dollar is going to sink. Now, will the Swiss franc be the main beneficiary of this round like it was in 2025? I do not know because the Swiss have now gone back to negative rates like it's 2015 again. So maybe it's the commodity currencies that get a reply. Your South African rand, your Brazilian real, your Latin American currencies. So all of them,
What's
maybe even the
interesting
African.
too, sorry to cut you off, but
Yeah,
what's interesting
sure.
about those as well is that those are holding up much better than the domestic market currencies. So that's another thing. That's um, another thing to think about when you're looking at the commodity cycle and trying to say whether it's happening or not. We're seeing that movement into these commodity currencies that Kashop just talked about. That's also confirming what we've been looking at.
Yeah, so I think it's going to continue. It's going to be a long-term downturn for the dollar, similar to how think of it the way the yen topped out. I think right around the eurozone crisis when the yen became a safe haven. Even though Japan had so the similar debt problems that the eurozone had, somehow investors decided no, let's avoid Europe and let's go to Japan, which is safe. And then Abenomics kicks in and they say we are going to depreciate the yen, and the yen has never managed to get back to those levels since. And why? Because once trend comes into play in the currency market, which reflects the real economy, it takes a long, long time to reverse. And that's also the reason why the AI bubble is so strong in the US, because the US has attracted so much capital ever since the Eurozone crisis, the Japanese crisis, pretty much every crisis everywhere in the world. It has been a one way street for almost the last 16, 15 years since the 2011 commodity bubble top. So, this trend is also taking a lot of time to reverse because the US has built so much goodwill that 1 year of Trump administration, Trump 2.0, isn't enough to shake investors' confidence in the dollar and the US as an economy. So I think it's going to take a lot more years of policy mistakes, a lot more years of $2-3 trillion deficits before the dollar really tanks. But the trend is in motion, so I wouldn't bet against it. I can see it accelerating, taking a break, maybe go to 90, then rebound to 92, 93, and then stay there for a while and frustrate everyone. But I don't see it going to 105, 110 the way it moved in 2022 when the dollar was a safe haven. So I think those days are long gone. And if anything, there is a global crisis, war, any situation, the beneficiaries will be the Swiss franc and not the dollar. So I think that's a bold statement to make, but that is how I see it.
I agree with that completely. That might sound crazy to some people, but I think that's the scenario we're in. And a lot of people don't know, like when you go look at past crashes, it's not a scenario most of the time where everybody is always rushing to the dollar. Most of the time it's in a panic, like in a panic type situation or a liquidity crunch type of situation where everybody in the world is selling everything. Most of the time you're going to see a pop in the dollar, but sometimes those can be very short lived. So that's something to pay attention to. Also, in crash scenarios, sometimes the dollar's going down with U.S. equities and so on. Everybody thinks that's going to always work the opposite. Also, something that we've learned in the last 5 years, which is something that conventional wisdom since 1982 would have told you different. Bonds also went down. Bonds in the United States and bonds globally are always looked at as a safe haven. Bonds went down in a crash scenario as well. So something to think about there. So I wanted to bring this up. So Wavy brought up, and I don't know if you're following this situation in Venezuela, but he said like the exploration stocks and the oil services and so on. He said, I'm 100% convinced that it's the Venezuela invasion trade. So I'm wondering what you think about this situation with Venezuela, the United States. I've seen Trump basically say some things. I've been paying attention to the news a little bit on it, but not a ton. Do you have any views on that situation at the moment?
So this whole thing started because Venezuela's neighbor Guyana, they discovered a lot of oil offshore. And this was controlled by a company called Hess, and Chevron took over Hess. And ExxonMobil wanted a part of Hess and they couldn't get it. Chevron took it over. And then Venezuela said, hey, so the complication here is Chevron also has operations in Venezuela. Venezuela said, hey, we want this oil, we want this province. We are going to hold fake elections here and take it over. And the international community got shocked. So what happened was Chevron kind of tried to play both sides pretty well. So they got their exemption to continue operations in Venezuela, even though it's a sanctioned country. And they got to keep producing oil from these offshore fields in Guyana as well. And then Trump comes in, and I don't know what happened in the back end, but the other part of the story here is there's a courtroom battle going on for Venezuela's U.S. assets. It's under a company called Citgo, and a lot of creditors, including the uh, Larry Elliott, so the Elliott Fund, so including them, they are all going after it. And so the backstory here is someone came in and outbid these funds, and they wanted to maybe do a show of force or something. I don't know what happened, but then the Trump administration started attacking Venezuela. Now, the goal here, the way I see it, is to get complete control over the Guyanese oil fields, is to get complete control over the Citgo assets. So if you look at what happened during the Russia-Ukraine war, the Europeans pretty much seized all Russian assets. They took over the billionaires' yachts, their homes, whatever wealth they could confiscate, they just confiscated it. So I think the US is doing something similar with Venezuela's US assets. It's going to do something similar with their oil interests in that region, and that's what the setup is. So that is my theory. There's obviously a lot more going on in the back end, and they keep this and so on, but I don't know what part of that is believable. To me, the way I look at it, geopolitics, it's all about the oil, it's all about Citgo, it's all about Guyana, it's all about the oil assets, and the narco thing maybe just cover for these moves. But I don't think this time the US will be as fortunate in their aggression against a South American country, because the world is watching and everyone knows it's now an oil story. And frankly, the US is a little weaker as an empire now that the Russia Ukraine war has been dragging on for close to 4 years and nothing has really come out of it. So I don't see this ending in a way that US controls the Venezuela oil fields. No, I don't see it happening that way at all.
Yeah, I don't either. And I think it's once again, like, look at economic history. There's a lot of great books on, like, not to mention Tales from an Economic Hitman. That's a great one. Something that you can learn basically how a regime change happens, how we kind of facilitate it in a way, and what happens after that. And a lot of people kind of know that situation now, so it doesn't happen to the same degree. I mean, it even happened in Venezuela at one point years ago, and they basically bucked it because they kind of understood what was going on. And I think that's going to be kind of the scenario going forward, is a lot of people do understand what we did. I think us getting away with Gaddafi, a couple other things, like, I won't get into all of them, but if you guys want to look into it, feel free. But when you're looking at, what happened in the Middle East, what happened in Africa with us, what happened in Iran in the 50s and so on, like, when you run through all that and you think, like, okay, well, we got away with a lot of shit at certain points, and I don't think, like, we can get away with it to the same degree. Doesn't mean we don't still have a huge military. Doesn't mean we don't still have the world's reserve currency. It just means that I think people are waking up to kind of the plan that we do from time to time. So I don't think it's going to work out the same way that it has in the past. So getting to the next one, we talked about the dollar. Let's talk about commodity sectors, not commodities themselves, but commodity sectors. So when we're looking at these commodity sectors, man, we're seeing this crazy returns. GDXJ up almost 150%, GDX up around 140, copper miners, metals and mining up around 77%, lithium stocks, steel stocks, and then below that we have the S&P 500, and all the way at the bottom we have energy. My big thought here is that I'm not thinking like, I really hate the term catch-up trade. I know everybody uses it. It drives me crazy because, one, it's not that I think there's anything wrong with it. It's that most of the time, like the things that are up a lot, even though they're going to scare the shit out of you, are probably going to be or continue up higher. And it really depends on what type of market you're looking at. Are you looking in a cyclical market, or are you looking at a, like tech stocks and so on? If you're looking at a cyclical market, though, there's times where you do go, okay, what is next? And so we did that with copper miners this year. We started buying the crap out of copper miners earlier this year. We went pretty deep into those. That would have been, I want to say, probably summer, maybe even a little bit in the spring. So we started to get breakouts, see a bunch of breakouts. We're buying those breakouts and so on. And then we're moving forward. And now it's okay, then lithium starts moving. Even solar stocks are moving. Steel stocks had that massive breakout, I think, a month ago. And now we're into the energy stocks. We're starting to see those start to move. So here is an interesting point where if you look at it historically and you go, okay, well, historically, has there ever been a scenario where GDXJ, GDX, COPEX, all these things, all these sectors? Now, going back further, I had to use individual stocks to research this. So going back all the way about 100 years, has there ever been a scenario where the energy stocks didn't catch up to these? And the answer is no. Like every single time the energy stocks start to move in a big way, and that will probably happen. To me, I really think that's going to happen this month or next month. I think that breakout of XLE above 97, 98 will happen within the next month. I think we're seeing it in all these sectors. I think oil services are a very interesting area at the moment. But I also want to ask Kashop, at the bottom here, we have the explorers. We have the XOP ETF. So do you think there's any value in trying to get to the explorers at the moment, or do you think it's similar to this is a question I wanted to ask you too, is it similar to the precious metal cycle, where we want to buy the best names, the biggest names at first, and then we want to start to move down the cap scale? Or do you think we should start to try the catch-up trade fully and go all the way to XOP now?
So that's pretty much what you first said. That's pretty much how I played the gold miners, and that's pretty much how I'm playing the energy space as well now. So I was an early energy bull, and I got rid of almost all my energy bets in the first half of this year because it was just not working. And it's not that they are not going to work at some point; they will. But staying in a trade, waiting, that's really not my style. So I just got rid of them. And recently I started buying one energy name in the large cap space. So I'm not getting into the smaller names yet because why bother? Let the space start to move. And here's the thing. So gold started moving in 2022. So gold bottomed in 2022. But if you caught the gold miners a year later in say October, November 2023, you did pretty well. You need not have caught that first 11, 12 months of the move in the gold miners to have really made money, because most of the returns have come in 2024 and then even more so in 2025. So oil is just starting to pick up. It's holding above 60. Natural gas is over $5. I think it's up 6% today, which is great. So we are just starting to see these moves now, and you can just hold the large cap names for now. And then once the cycle really ticks off, it doesn't matter if you're buying into the smaller cap names even a year later. That's my point, because I have done this with the mining stocks and that's worked out pretty well with almost no volatility. In fact, like the volatility that we got was mostly just gold going sideways and people like getting frustrated rather than gold going down 40% and people thinking the trade is over. So the frustrating part, just sitting through a trade which goes nowhere, that doesn't bother me. But the volatility where the stocks go down and up a lot in short order, that bothers me. So I would just stick with large caps now, wait it out, and then pick up the pieces once the bull market really gets going. So if we see oil over 80, let's say, then that's a clear signal to go heavily into the producers, the Canadian companies, the Permian Basin companies, even the African producers. I'm sure there'll be a lot of small cap stocks launched where they're focusing on Africa and other exotic places. So we would probably go there. We would buy Colombian oil stocks for the dividend yield. We'd buy the national oil companies for the dividend yield. So I think that time will come probably a year later, or once oil is steadily above $80, not now. For now, I just want to be in the simple trade, which is the large caps.
Yes. And so so we got another question here, and this kind of made me laugh, which is talking about the and not laughing at you, Mark, laughing at the I had a funny story that just came up about this. So EWJ versus DXJ hedged. How do you make a decision about which of these two vehicles would you own? Or maybe I should ask, why would you choose DXJ? So I have a friend who works at JP Morgan. Matt, if you're out there, you made me laugh the other day. But anyways, so my buddy hits me up and he's like, yeah, he's getting an argument with these advisors, basically getting upset about like DXJ compared to EWJ and how they're not making as much money and how they wish they were in EWJ. And he's just like, dude, it's hedged. Like, of course it's not making as much money, it's hedged. And so like, how do I trade something like this myself personally? I never use the hedge version of anything. If I want exposure, I want the full exposure to it. There's probably a time and place, but I'm not I'm not running a retirement fund over here. I'm not going like, hey, I need the lowest volatility return and some exposure to Japan to tell my investor. Like, really, let's be honest. Most of the time, I want to tell my investors I'm also in these different areas and I'm thinking outside the box. Therefore, how do I do it in a safe way? And I feel like most of the time, the hedge trades come from people who are like terrified of international investments generally. So they just go, okay, I'd rather be in something that like, I mean, at that point, just go buy the S&P 500 and walk away. But I mean, if you want exposure to things like these different ETFs and sectors, like I choose just to stick to EWJ, like that's in my portfolio currently in the long-term portfolio, or choosing like any of these international ETFs that are unhedged. Like that's what I do, because I want the exposure if I'm getting in that area. And if I'm looking at their currency and going, their currency's crap and so on, I'm probably not going to invest in it anyways. So Kashaf, do you have any thoughts on this?
No, I don't really trade the ETFs. So if I'm picking something in Japan, I would probably pick a bank or industrial stock or Toyota Motors and not get into the ETF. But
And
if
then you're
I'm
going to
getting into
buy
the
a
ETF,
bunch of put
yeah,
options on that. I'm just kidding, but that's really like what it is. It's like buying the stock and then buying put options on said stock. It's just like, why? What's the point? Like, if you don't want to own it, just don't own it. And if you want to have an exit where you're going to get out at some point, just make an exit. Use a stop loss. Like, get out at some point. That's all you have to do. But if you want exposure to Japan, have that exposure. Whether it's buying the individual stocks or whether it's buying the EWJ. If you like Japan. I'm sure I'm long Japan, but I also don't like Japan much. Looking at the yields right now, that's a story. Something actually Sam sent me this morning that I literally forgot to put in the slide deck. But not EWJ, sorry, Germany, their bond yields are hitting new all-time highs right now. And also Japan bond yields are hitting new all-time highs right now. And everybody thinks that can't happen in the United States. They are crazy. You are going to see the craziest rip in bond yields at some point, and everybody's going to be like, man, Jason's been talking about this for a while. I've been short bonds since 2020. I had one flip of a signal this entire time. Like, I'm still short bonds. I will probably continue to be short bonds. I can't see a reason that would change. The price would have to completely shift. You'd have to have TLT ripping and hitting new 52-week highs, and then maybe I'd change my mind. But at the moment, it's like you're seeing energy bubbling up under the surface. You're seeing inflation moving up. You're seeing all the price action across the board is basically telling you that inflation is here. And then you think that bond yields are going to stay low. And not to mention Donald Trump, like a lot of people keep talking about, well, Trump wants this and Trump wants that. He's saying he wants lower oil prices and gasoline prices, and he's about to run it hot, guys. He's about to run this shit as hot as it goes. This guy is going to get in there and he's going to literally be like, okay, Fed chair, I got the guy. I mean, he already said it. I got the guy in mind. He already knows who he's going to pick. Great. Why do you think he's going to pick him? Because he's going to tame inflation? Because he's going to make the economy soft? And no, he wants to run it hot. He wants equities to go up. If you want equities to go up, all the money that you're going to give out isn't going to just go to equities. It's going to go to the commodity sectors. It's going to end up with more inflation. It's the reason why they didn't want to cut rates in the first place. So I think here's an interesting scenario, which is things are about to run hot. And I don't know if it's a equity rally where the Mag 7's leading. I don't think that's the scenario. I think what's happening, and once again, everybody keeps talking about the technology doing so good out of the spider sectors, and I'm sitting over here looking at this and going, okay, well, do you see the other returns? How much these are outpacing the S&P 500, the technology sector, the Mag 7, and so on? I mean, once again, pick what you want to invest in, but I choose to pick the areas that are going to make the most money in the scenario we're headed to. And I think we're headed to a melt-up scenario, and I think the energy sector is really going to rip right now. I think we're looking at it. I think it's going to happen pretty soon. And Wavy said, oh, man. He said, I'm like you, Purrs. I don't hedge. I raw dog these girls. I mean, I'm going to bring that up on the show and say it. And Wavy, I'm proud of you. I'm proud of you. Wavy, one time, me and Kevin got on a Saturday morning, and Wavy said, oh, it's money time. And I had to kick the girl out of bed. I was like, damn. Okay, Wavy. So Wavy's always making me laugh. It's good people. But anyways, looking at the market here, I just think we have a great scenario here that's amazing for the commodity sectors. And another thing I wanted to highlight today is, as we're seeing, as Rick sent me this the other day, out of the top 10, we have 5 commodity sectors here. Obviously, silver and gold are way at the top in the relative strength rank that we have. And then copper is right below that. And then industrial metals and mining, uranium. Below that, we have aluminum, coking coal, oil and gas drilling, and then we have steel. So, I mean, do we think this looks like it's not a, does this look like a Goldilocks style of a market? No. This is not a Goldilocks style market. This is a reflationary market at the moment. And reflation usually turns to stagflation. That's the other thing, like a lot of people don't think about, which is reflation means that you have some of the commodity sectors and all of these stock sectors that are broad, like cyclicals and so on. These all move kind of together. And then we kind of get this global reflation where they're all moving together. And then once there's enough pressure put on and oil starts to catch up, that puts pressure on the entire economy, and all these stocks start to get pressure on the top of them. And the next thing you know, we get to that stagflationary period where just the commodity sectors are really moving. And then after that, we usually get into a disinflationary shock that's going to happen because that much pressure on the economy has to come off at some point. Think of 2022, and you get a crash in the commodity prices and so on. So, looking at this here, Kashop, what do you think is the place out of not the top? Obviously, we know we've been talking about silver, gold, copper, industrial metals, and so on, even uranium a bunch this year. What are we looking at down here that we think is interesting areas to possibly look for investments coming up?
So definitely. So here's the thing. You're pointing out the commodity sectors, and interestingly enough, I have commodities and I also have luxury. So luxury was my value trade for this year, which has worked amazingly well. So I have one casino stock and 3 direct luxury good stock, and surprisingly they have worked. And that is because 2022 was a mean reversion, a reset in terms of their sales and their growth trajectory, but then the luxury sector just keeps booming, and it's part of the same reason that the Fed money printing has led to asset price inflation, because the luxury goods are also kind of seen as assets, just the not the kind that you hold in your brokerage account. So they've done well. I still believe in that trade. And shipping, I think it's going to do well, but you really have to pick your spots. So I know the spots I'm in. I'm not looking to add more. Oil and gas drilling, this is tricky. And the reason it's tricky is because of the tariffs. So the tariffs really hurt the margins of the oil service companies. So what is really going to happen with the tariffs? How are they going to really plan for it? How are they going to do their pricing given these uncertainties? That's the question. It's not a direct question of whether demand for more oil wells, demand for more drilling in more oil fields will come up. It's a question of what is going to happen with the tariffs, how is it going to impact their margins, how is it going to impact their pricing power. So once there is clarity on that, then I think the oil and gas drilling sector looks good. And you also have to take into account the fact that these stocks are volatile, and they're volatile not just because they move with the oil price and with these tariffs, they're also volatile because they have a lot of debt. Now, if the recovery doesn't start soon, then the debt becomes a big problem. If the recovery starts right away, then the debt gets easily handled. So they have this optionality because of the financial leverage as well. So you have to take that into account and really pick your spots. Right now, I'm not looking at this sector. I mean, I'm looking at the sector. I don't have any positions in this sector, mainly because I want a bit more clarity on what's next for them before buying in. Because I think once we have that clarity, it's going to run the same way the gold miners ran this year. It's just that when is that going to happen? I do not know. So for now, I'm going to just stay out and keep watching.
Yeah, it's a way to do it. I think it's, a lot of people think, when we're talking about energy moving next, we're just going crazy and buying it all because we think it's going to move next. And the answer is, for me, it's continue to watch the price action zones. Like if you get above those zones or whatever your buy signals are, then get into it. Then buy this thing. If it continues to chop around and be frustrating, like just wait for it to get out of that frustration zone. It's part of the reason why like a lot of people shouldn't buy things when they're range bound. It's not because like it's impossible for it to go up. It's just the fact that it's sometimes very frustrating to do it. You're in a tight range. You're in, let's say, a Bollinger Band squeeze, and you're trying to buy this thing, and it's basically just chopping around. You're not really losing a ton of money, and you're not making a ton of money, and you're really waiting for that breakout. And then by the time you might get close to that breakout zone, you might have been frustrated enough to just get rid of the position altogether. Instead of with just waiting for that breakout, and once that happens, see what it does after that, and it's probably going to trend a lot better. The only time you really want to buy inside of a range is, one, if you're looking for like an extreme value zone, or two, if you're looking for options. If you want to buy options, like here, really, like here's a great trade that I think is amazing that a lot of people should take advantage of, which is find these energy stocks, go buy leaps in these energy stocks, 6 months to a year out at least. Calls probably go out of the money about 10%. If you're looking at the ETF, probably 20% on the stocks. I think you'll make a ton of money in the next 6 months. I think that's a really good trade coming up here that a lot of people are going to overlook. So looking at the next one, well, we've highlighted the coal stocks quite a bit lately. Getting to this one. So we're looking here, I guess, Kashop, to ask you, and we'll end on this. Is there any catalyst you're looking for here for oil to take back over and maybe start to get out of this depressed range it's been in for a really long time?
The catalyst will be inventories going down to alarming levels. So the reason the oil market is complacent right now is because inventory levels are high. And you can check these charts, you can look at inventories and where they are in terms of the 5-year range, and you can see that they are running at a pretty high level. And every report that comes out, or almost every report that comes out, shows that the inventory draws aren't what the market expects. So when you have the situation, people are complacent. So when will that end? That would probably end one of two ways. One is demand picks up so much that, a reflationary economy, demand picks up, $2,000 stimulus checks to everyone, and people start driving more, and then it's boom, it's off to the races to a stagflationary situation with a lot more stimulus checks. The other environment is if the Russian oil flows, the Venezuelan oil flows, the Iranian oil flows, all of this completely dries up. Now, the Treasury sanctions on Iranian vessels, the vessels transporting Iranian oil, has gotten a lot more strict of late. So this is already happening. And Venezuela, it is turning into a war zone. So this is already happening. The missing picture is Russia, because Russia has pretty much managed to keep its flows going regardless of, I think the Europe is up to some 18-20 rounds of sanctions right now, and it has had zero impact on Russian oil. They just keep moving it. So if that changes, then you would see some kind of impact on the oil price, or kind of a price shock from which oil can start its run higher. I just don't see it happening, and I don't see it happening because if this were to have happened, it should have happened already, and it hasn't happened yet. So I don't know if it will happen. I don't know if that makes sense, but that's how I'm
Yeah.
thinking about it.
No, like I like that. I think it's, looking at the price action levels can tell us a lot, but also paying attention to what's around the corner is going to be very important. So I think that, looking at it here, I think to end everybody on something, which is I think this month you really want to pay attention to the energy sector. I think the big names are actually looking good. The US producers, those are actually, or the U.S. large caps, those are actually looking really good at the moment. The refiners are looking even better. And then globally, the international names are doing even better. Shell's been one of our picks that we've had for a little bit now. That's up, I think, 17% at the moment. Once again, it's just getting started, but these things are in break, like things like BP, that's in a breakout. Same with Shell, that's in a breakout. So if you're looking at the international names, they're already started moving. Domestic producer that we've recommended is or domestic name that we recommended is Baker Hughes. So that's another one we own. So there's a lot of them that are moving already. It's just, I think you got to be patient here because it's going to take some time and own the best of the best. Kashop and I both mentioned the same way we were playing gold miners when we told you guys we're buying the large cap names at first. Now we're doing that in the energy stocks. I'm doing the same as Kashop said as well. And so, all right, guys, hope you guys had a good one. Shop, do you have anything to end on?
No, I think this is perfect. Thanks, everyone. Have a good evening.
Thanks for joining us, guys. We'll see you soon.